Accounting often values assets based on historical costs. This can lead to distortions, especially when the market value of an asset differs significantly from its historical cost. It's like valuing a vintage car based on its original purchase price without considering its current market demand. Not always comparable. Comparing financial statements of different companies can be like comparing apples to oranges. Variations in accounting policies, practices, and standards can make it challenging to draw meaningful comparisons. It's like trying to judge two artists who use different canvases and paintbrushes. Overemphasis on quantifiable information. Accounting tends to prioritize information that can be quantified and measured. Qualitative aspects, such as the expertise of employees or the effectiveness of management, may not receive adequate attention. It's like judging a painting solely by the number of colors used, ignoring the artistry involved. In essence, while accounting is a valuable tool, it's important to recognize its limitations. It's like a map that guides you through known terrain but may not reveal uncharted territories or predict the weather ahead. Decision-makers should use accounting information judiciously, complementing it with a broader understanding of the business environment. We will now learn the stages in the accounting process. These are the stages in the accounting process. 1. Collect and analyze information from source documents. 2. Record it in a journal. 3. Post transaction to the various ledgers. 4. Balance off accounts and prepare the trial balance. 5. Prepare financial statements. 6. Record and post adjusting entries. 7. Analyze and interpret the accounts. Now let's take each point one after the other. Collect and analyze information from source documents. Imagine you're the detective of the financial world. Your first task is to gather clues from source documents like invoices, receipts, and bank statements. You're on a mission to understand the financial activities of the business. Record it in a journal. Now that you have your clues, it's time to organize them in a journal. Think of the journal as your investigative notebook. You jot down each financial transaction, noting the who, what, when, and where. It's the chronological record of the financial story unfolding. Post-transaction to the various ledgers. The ledgers are like the categorized sections of your notebook. Take each transaction from the journal and put it in the right category. If it's about cash, it goes to the cash ledger. If it's about sales, it goes to the sales ledger. It's like filing each piece of evidence in the right folder. Balance off accounts and prepare the trial balance. Time to check if everything adds up. Balance off each account in the ledger. It's like making sure your financial books are in order. Then, compile all the balances into a trial balance. It's your midterm report card, a snapshot of the financial landscape so far. Prepare financial statements. It's showtime. Use the trial balance to create the financial statements. The income statement tells you how much the business made and spent, and the balance sheet shows what it owns and owes. These statements are like the climax of your financial story. They reveal the financial health of the business. Record and post adjusting entries. Now, let's fine-tune the story. Adjusting entries are like editing your financial narrative for accuracy. If there are accrued expenses or unearned revenue that didn't make it into the initial recording, now's the time to include them. It's like ensuring the plot is flawless. Analyze and interpret the accounts. Time to put on your analyst hat. Look at the financial statements and interpret what they're telling you. Analyze trends, ratios, and anomalies. It's like reading between the lines of a novel, understanding the nuances and getting insights into the business's performance and potential challenges. In essence, the accounting process is like unfolding a financial story. You start with scattered clues, organize them into a coherent narrative, ensure the plot is accurate, and finally, analyze the story to understand its implications. It's a journey from financial data collection to insightful interpretation, all aimed at helping businesses make informed decisions. Now let's see the users of accounting information. For the purpose of this course, management, employees, owners/shareholders, internal auditors, investors, creditors, regulators, and tax authorities, customers, competitors, and analysts and financial advisors were considered as users of the financial informations. Now let's break it down. Management. Internal management uses accounting information for planning, decision-making, and controlling day-to-day operations. Financial statements, budget reports, and performance analyses aid managers in assessing the company's financial health and making strategic decisions. Employees, especially those in management roles, may use accounting information to assess the financial stability of the company. This can influence decisions related to employment, compensation, and participation in employee stock ownership plans, ESOPs. Owners/shareholders. Owners and shareholders rely on accounting information to evaluate the profitability and financial health of the company. This information helps them assess the return on their investment and make decisions about holding, buying, or selling shares. Internal auditors. Internal auditors use accounting information to assess the effectiveness of internal controls, compliance with policies and procedures, and overall risk management within the organization. Investors, including individual investors and institutional investors, use accounting information to evaluate the financial health and performance of a company before making investment decisions. Creditors, such as banks and suppliers, use accounting information to assess the creditworthiness of a business. This information helps them make decisions about extending credit, setting credit terms, and determining interest rates. Regulators and tax authorities. Government agencies and tax authorities use accounting information to ensure compliance with financial regulations and tax laws. Financial statements are often subject to external audits to verify their accuracy. Customers may use accounting information to assess the financial stability of a supplier or service provider. This information can influence decisions related to long-term contracts and business relationships. Competitors may analyze publicly available accounting information to benchmark their own performance against industry peers and identify potential areas for improvement. Analysts and financial advisors. Financial analysts and advisors use accounting information to provide recommendations to investors. They analyze financial statements, assess financial ratios, and conduct industry comparisons to offer insights into investment opportunities. The next thing we will also discuss is the branches of accounting. The branches of accounting includes 1. Financial accounting. 2. Cost accounting. 3. Management accounting. 4. Taxation. 5. Auditing. 6. Government accounting. Let's look at the difference between financial accounting and management accounting. The differences would be based on purpose, time frame, reporting standards, scope, and regulatory compliances. For the basis of purpose, the primary purpose of financial accounting is to provide information to external stakeholders, such as investors, creditors, regulators, and the general public. It focuses on presenting a company's financial performance and position in a standardized format according to generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS. The main purpose of management accounting, on the other hand, is to provide information to internal management for decision-making, planning, and control. The audience for management accounting information is typically the internal management team of an organization. On the basis of time frame, financial statements are prepared periodically, usually quarterly and annually, and provide a historical perspective on the company's financial performance, whereas reports and analyses in management accounting are prepared as needed and are forward-looking. They may cover short-term and long-term periods based on the needs of management. For reporting standards basis, financial accounting follows established accounting standards, GAAP or IFRS, to ensure consistency and comparability across different companies. However, there are no specific standards for management accounting. The reports are tailored to the specific needs of the organization and may not follow standardized formats. In relation to scope, financial accounting covers the entire organization and provides a comprehensive view of the financial health of the company, whilst management accounting can be specific to departments, products, projects, or any other internal segment of the organization. It focuses on providing detailed information relevant to internal decision-making. With regards to regulatory compliance as a basis, companies are legally required to prepare financial statements in accordance with applicable accounting standards for external reporting purposes, whilst there are no legal requirements for the preparation of management accounting reports. The content and format are determined by the internal needs of the organization. Now let's look at the last topic for this session, which is difference between financial accounting and cost accounting. The comparison will be based on purpose, scope, external versus internal reporting, regulatory compliance, and time frame. Regards to purpose. The primary purpose of financial accounting is to provide information about the overall financial performance and position of an organization to external stakeholders such as investors, creditors, and regulatory authorities. It is concerned with reporting financial results in accordance with accounting standards. Whilst the main purpose of cost accounting is to gather, analyze, and report information about the costs incurred in the production of goods or services within an organization. It helps management in making decisions related to cost control, pricing, and efficiency. Using scope as the basis, financial accounting provides a comprehensive view of the entire organization, covering all financial transactions and events. Financial accounting statements, such as the income statement and balance sheet, are prepared for the entire business entity, whilst cost accounting on the other hand focuses specifically on the costs associated with manufacturing or producing goods and services. Cost accounting is often applied to specific products, projects, or departments within the organization. Using external versus internal reporting as a basis. Financial accounting primarily concerned with external reporting to stakeholders outside the organization, such as shareholders, creditors, and government agencies, whereas cost accounting is primarily used for internal reporting purposes. The information generated by cost accounting is for the use of internal management to make informed decisions regarding costs and operations. For regulatory compliance basis, companies are required to prepare financial statements in accordance with established accounting standards, such as GAAP or IFRS, for external reporting, and these statements are subject to external audits. For cost accounting, companies are required to prepare financial statements in accordance with established accounting standards, such as GAAP or IFRS, for external reporting, and these statements are subject to external audits. On the basis of time frame, financial statements are prepared periodically, quarterly and annually, and provide a historical perspective on the company's financial performance, where cost accounting involves continuous monitoring of costs and may provide real-time or more frequent reports to aid in decision-making. This brings us to the end of the lessons. The channel is TechByte Insight. Kindly subscribe. See you in the next lesson. Thank you.